Good day. Today we are going to focus on the term accrued income, or what is called the income receivable. But before we go there, we need to come to the term that is called the matching. The matching, the gap principle, it is called the matching. What is the matching saying? The matching is saying that incomes, incomes and expenses should be recorded in a year that they belong in, even if they they have not yet they have not yet been received or paid. That is the matching. It is saying that the incomes and expenses should be recorded in a year that they belong in, even if they have not yet been paid or received. Okay, that is the matching. It is saying this. Okay, so let's come here. Let's continue here. Accrued income. What is the accrued income? So let's come to the word income receivable. Okay, income receivable. The receivable word, it means that the amount owed to the business. So this means that someone is owing the business money. So they are owing the business its income. Okay, so this is the income receivable. So actually, accrued income is the amount owed to the business. It's an income that is owed to the business. So this means that someone out there is owing the business some money. Okay, someone out there is owing the business its income. For example, someone out there is owing the business the commission income, or someone out there is owing the business the rent income. Okay, that is the accrued income. Okay, so because we are talking about amount owed, so what do we know about the amount owed to the business? Amount owed to the business, what clicks into your mind? The debtors. Debtors. These are the people that owes the business money, right? So the debtors, they are what to a business? They are an asset, right? They are an asset. So actually, these two, they are similar, but it's not the same thing, but they are similar. Both of them, the debtors, they owe the money to the business, and also here, still the same thing, the amount is owed to the business. Okay, it's almost the same thing. So actually, the accrued income is an asset account. So this is a new asset account, because this is new. This is a new term in grade 10. So the accrued income, it's an asset account, because this is the amount is owed to the business. Okay, so the business is expecting to receive money. Okay, so this is an asset account. So we know that the asset, they increase on the debit side and decrease on the credit side. Okay, so it's like this. Okay, so what is supposed to happen is um, if ever there is an information that is telling us that there is a certain amount that was not recorded in the financial year, okay, a certain amount that was not recorded in the financial year, which is an income. So, but then it belongs in the financial year, okay. So this means that we need to come here to the accrued income and record it. But then let's go to the example so that we can do it. Remember, I said that this is an income account. I mean, this is an asset account. Now, let's look at this. Let's have a look at this. Now, on 28 February 2011, the accumulated period, okay, 28 February 2011, okay, 28 February 2011. So, if this is our year end, this means that our year started on 1 March 2010, and then it ends on 28 February 2011. Remember, your financial year must be a full 12 months. Your financial year must be a full 12 months. Okay, so they're saying on 28 February, the accumulated period footings in the general ledger of MN traders of the rent income account totaled to 55,000. So we are told that the rent income, it is how much? 55,000. Okay, so let's open the T account of the rent income. Rent income. So we know that the rent is an income, so the incomes, they increase on the credit and decrease on the debit side. So where do we write the balance of the income? We must write it on the credit side because the incomes, they increase on the credit side. So therefore the balance must be written on the credit side. It's how much? 55,000. This is a rent income. Okay, it's given here 55,000. Now let's look at the information. Adjustment. Rent has been received from a tenant for only 11 months. For only 11 months. Remember this. Remember this. You need to remember this. The year is a full 12 months, right? The year is a full 12 months, but we've only received the rent for only 11 months. This means that there is a rent of only 1 month, one month that we have not yet received. Okay, so now, but then, so this means that the rent that we did not receive is only 1 month, right? So, but then, what we know is that the incomes, okay, the incomes, they must be recorded in a year that they belong in, even if they have not yet been received. Yes, even if they have not yet been received. That is a matching. It is saying that the incomes, they must be recorded in a year that they belong in, even if they have not yet been received. Okay, so now let's do this. How much is this? 55,000, right? So this is 55,000. We want to know that the rent, it was how much per month? 55,000 divided by 11, it is 5,000. So this means that the rent of only 1 month is how much? It is 5,000. And the value we have not yet received this rent of only 1 month, right? So now what do? We are told that incomes, they must be recorded in a year that they belong in, even if they have not yet been received. So meaning that we have to come and record this rent of 5,000 rand. Yes, we have not yet received it, but then we need to come and increase the rent income. So actually, once you see that there is an accrued income, so you need to go and increase your income account. Okay, so the journal here, it is GJ like this, right? Now, which other account is affected? It's an asset account that is called an accrued income, because here we have an accrued income. Remember what I said about the accrued income. I said that the accrued income, this is the amount owed to the business. So this amount of 5,000 is owed to the business by this tenant because he only paid the rent of only 11 months. So now, where does the asset increase? The asset increase on the debit side. So we need to come and increase the accrued income with the 5,000 rand, because the only amount that is accrued, it is 5,000, not the 55,000, because 55,000 is already received. Okay, so the journal is a GJ, right? Now I come here. Now, so where is this 5,000 rand going? It is going to the accrued income account. Remember, you cannot write rent income under rent income. So this 5,000 is coming from where? It is coming from the rent income. You need to remember that the double entry system, it is saying that for every transaction, two accounts must be affected. And then it is saying that if something is credited, it must also be debited, right? So if this 5,000 rand is debited, is credited, we must also go and debit it to complete the double entry system. So we have completed it right now. Okay. Now, I want us to come and do this in the accounting equation to see that how was this going to affect the accounting equation. To see that how was this going to affect the accounting equation. So this is the liability. So it's the owner's equity. It's the asset. And then let's just write here amount. Okay. So this is credited account and debited account. So which account is debited? It's the accrued income. It's debited by 5,000. It's the accrued income. Which account is credited? It's the rent income. It's credited by 5,000. Rent income, right? How much is it? 5,000 rand. Okay, we are doing this for this rate. Okay, and then what is happening to the asset? The accrued income is increasing, and the accrued income is a what? It's an asset. So meaning that under asset we put a plus sign to show that the asset they are increasing. Okay, what is happening to the rent income? The rent income is being credited with a 5,000. And we know that the rent income is an income, so meaning that it is increasing. Now, the rent income. So the incomes, what do they do to the owner's equity? The incomes, they increases the owner's equity. So we don't have the liability. So that is your accrued income is like this. Thank you.